Good afternoon. Are you there? Okay. Uh, so it's 4 o'clock. I'm very sorry because being late, but I informed a bit advance due to some unavoidable reason. I had to be late, but nevertheless, we'll try to basically cover the materials as we planned, and also maybe I will run. Few minutes, I mean, even after 5:30. So I hope that would be okay to cover up for the lost time. Now, if you remember what we have been discussing up to now, financial institutions, and we were talking about key financial intermediaries starting from the banks. And in relation to banks, we talk about the financial, the, the economic functions of the banks. And also we looked at bank business model, especially their activities in relation to balance sheet activities and non-balance sheet or off-balance sheet activities. And we talk about balance sheet activities as interest-based or fund-based activities, because they are based on the funds of the resources of the finance bank, the financial institution. And we also talk about the non interest based income or activities or fee based activities. So fees and charges, one of the key incomes of the banks, and banks are earning money based on these two activities. So I told you, if you take a bank's formula, profit formula is simply the difference between revenue and cost. And if you take the revenue, you can break it up for two major parts, basically the interest income and non-interest income. Interest income means interest generated through the income generated through the fund-based activity or interest-based activity. Non-interest income means simply the activity, the income generated through the fees and charges and similar income sources. And I hope you got some clear idea about this on balance sheet and off balance sheet activities. And we also looked at the sample balance sheet, how it looks like. It could be different, or the format could be different based on the presentation of the accounting principle. But uh, in spite of the differences in the format, basically there will be key items in the balance sheet on the asset side and the liability side. And we identified in the asset side there are four major items, like the cash items, the securities, the loans and advances, and other assets. And among them, we identified loans are the most important category in the bank balance sheet. On the liability side, we identified deposits, that is their major liability, being a bank. And they also got borrowings, which means borrowing from other institutions or maybe from the central bank, and also their capital. So the difference between these the asset and the liabilities, basically in terms of the deposits and borrowings, we simply identified it as a net worth of the bank, which is a buffer to the financial institution. We need to have some capital, and banks or bank regulators, they are very much particular in having enough capital of a bank. And then we looked at off balance sheet activities and some examples also. As I mentioned, some of the instruments like acceptances, document credit guarantees, these are uh, activities done by a bank, not for interest. By offering these activities, banks are earning fees or charges. And they also engage in foreign currency transactions, foreign currency exchange, future contracts, and all that. They earn some again some fees, some income out of kind of a fee income. So all these are non-interest income, and we had some discussion on this as well. And then I discussed some of the different types of banking. If I remember correctly, I also mentioned to you, look at some of the questions in the latest exam paper. I'll come back to that point in a minute. And then the different products, the services of a bank, and the risk. We talk about some important risk faced by a financial institution, and I clearly identified in this slide. Uh, these are the main three risks of a financial institution or a bank: credit risk, liquidity risk, and the market risk. So these are considered as very important, because if one of these risks are affecting the bank will be basically run into a trouble. For example, credit risk means the default. Their borrowers are, or their investors are basically defaulting. So in that case, banks would experience some increase in non-performing loans, etc., and their provisioning has to be expanded. So that will create some problems. Liquidity risk also another issue. Market risk is generating losses to the balance sheet or the income statement by way of uh, mark to market method. Mark to market method means you are uh, valuing your assets based on the market prices. So if the prices are changing, any of these prices like the interest rates, asset prices, exchange rates, all these are affecting the bank's performance. So these are some key risks. And also I mentioned some other risks also, like operational, reputational, and macro risk. And in the recent scenario, we have also seen some new risks are emerging, like the cyber risk. Cyber risk is simply the risk arising through the information and technology systems, basically the web-based risk. We talk about those as well. And then risk management aspect also we discuss. Now, risk management aspect, I didn't expend too much of time on that, because we will come back to this again in very last maybe one before the last session, when we look at bank regulation. So when the banks are regulated means simply the banks are supervised, and banks are basically controlled in the sense the banks are monitored by the central bank or the authority. They will look at certain indicators. So those indicators, one key indicator is capital, and whether they have enough liquidity, whether they are complying with the rules and regulations, whether they have better management practices, corporate governance, and things like that. So these things are very important. All are related to risk mitigation of the banking institution. Risk mitigation means you bring down or you reduce the risk as much as possible. Now it is obvious you can't have a zero risk, right? Anywhere you cannot have zero risk. Risk cannot be completely avoided. Still, there will be some, even if you have some methods in place. So the idea is banks are trying to maintain a certain standards by bringing down these risks. So for that matter, risk management practices are there in the banks, and those are used to run the bank in a smooth manner or an efficient manner. So that was the discussion we had up to last week. Now let me move to, as I said, the some of the uh, questions in the very latest paper. Latest paper we have is basically the September 2019 paper, uh, applicable for the bank's context, right? So some of the things we have not discussed actually, for example, regulation and all that we haven't discussed up to now, but let me capture some of the uh, financial some of the questions related to the banking sector, and I told you some couple of things for you to look at on your own, uh, but let me take a couple of questions from the latest paper. Okay, so I'll switch back to the video mode, and because I'm expecting you to answer. uh, I would like if you speak, but if you are not comfortable with speaking with your the device, or since you are basically in a virtual mode, but at least try to type the answer. Now one of the questions I asked, okay, uh, I gave you a couple of things to look at, but I'll pick some from the paper directly. Now one question is, this is from question number 1, basically question number 1b4. In the case of Sri Lanka, this question: what is the applicable interest rate when a licensed commercial bank borrows from the central bank of Sri Lanka on overnight basis? I repeat, what is the applicable interest rate when licensed commercial banks borrow from the central bank on overnight basis? What do you think? I think we discussed this under monetary policy, and I'm hoping that you have uh, clear understanding on the what we have discussed. So I already see an answer from Krishni. The rate that the commercial banks borrow from the central bank is actually the in the case of Sri Lanka, you are right. Basically, uh, standing lending facility rate. You are right, Krishni. SL FR, what we call it, SLFR, standing lending facility rate. Or in other context, in other countries, there could be different rates, different names. For example, some country might say that is their discount rate. Some country would say that is their reverse repurchase rate. Some country would say the bank rate, whatever. Basically, the idea is the central bank is giving loans to commercial banks by keeping securities with them. Securities are basically the collaterals for the loan. So in the case of Sri Lanka, the commercial banks borrow by pledging their treasury bills and treasury bonds as the collateral, and under that they borrow on overnight basis. Standing lending facility rate is the applicable rate. Remember, it's an overnight basis, which means you borrow today, you reverse tomorrow, right? So it is the SLFR. So what is the rate right now? If you remember the rate, because I told you in the exam you have to have your numbers also. Can someone answer what is the current SLFR in Sri Lanka, the rate? Do you have any idea, Krishni? What is the current rate? 5.5. Tishara, yes. Vimandi, 5.5. Answer is correct. We have a corridor. Upper bound of the corridor is SLFR 5.5, and the lower bound of the corridor is SDFR, standing deposit facility rate. It is 4.5. You are correct. And I'll ask another question here. Uh, this is not an exam question, but very important question. Now, let's say this is actually from the central bank. People come to the central bank for this standing lending facility rate because that is the final option of the day. In the afternoon, they come to this rate at 5.5, right? Now, before coming to the central bank, there are other, ways and means that the commercial banks can borrow. Can you mention two places that the commercial bank can borrow without coming to the central bank? Two places that the central bank can borrow. It is not an exam question. I'm putting it as an exam question. What are the two instances or markets or institutions that the commercial banks can borrow before coming to the central bank to borrow? What do you think? Through primary dealers. Okay, answer is not perfectly correct, but I understand what you are trying to say. Now come back to that point. Any other answers? What are the other avenues that the commercial banks can borrow, let's say on overnight basis? Overnight means you borrow today, settling tomorrow. How about others? Any answer? Sachika, any answer? Do you have any answer? Tishara? Wemande? I'm just talking to the people who are responding to me, but I see a lot of people are there. I'm just calling names with the people who are interacting with me. How about others? Do you have any answer? What are the means for the commercial banks to borrow? Let's say in the morning, the commercial bank, maybe you are a commercial banker, right? You are working in the bank, in a commercial bank or any other bank. Let's say in a commercial bank, in the morning you observe, okay, there are, a lot of pending withdrawals by the customers, and you have to honor them. You have to give their deposits back. And you observe, you need some money, maybe an investment is maturing, you have to pay back, right? So what are the options that you have? Central bank, this rate is the last option in the day. Before coming to that, there could be other uh, ways. By asking from other banks, Sadisha, you are correct. What does that mean, Sadisha? You can ask from other banks. You call it a specific name. We have a specific name for that bank market. What do you call it? Interbank call money market. Exactly. So that is one option. Commercial banks can borrow from the interbank call money market. Not interbank, but interbank. Interbank means within the banking sector, which means only the banks are there. And when commercial banks borrow and lend in this market, we have an average rate for this market. Very important average interest rate. What do you call it? Can someone say? What is the average interest rate in this interbank call money market? Any response? The interest rate in this interbank call money market. Only the banks are operating in this market. Any idea, Sadisha? Any idea, Krishni? What do you think? What is this rate? An important rate for the central bank also. Bank rate, actually, that is an interest rate when the commercial banks want to borrow from the central bank as the last option. You call it last resort, remember? When no one is giving money to the commercial banks, that is the rate, bank rate. That is by the central bank to commercial banks. Now this rate, interbank market, that is among the banks. There you have a rate, a defined interest rate. We call it as an average. Which average? I am asking. You know this, and this is very important for the central bank. Average weighted call money rate, exactly, Vimandi. AWCMR, remember? I told you this rate is important for the central bank because the central bank's monetary policy is basically implemented to manage this rate without having any volatility. So I remember, if I draw it on the board, I told you the central bank is trying to minimize the volatility of this interest rate. Remember, if this is the corridor, the call money rate is like this, right? Central bank is trying to minimize such volatility. In this case, central banks provides funds to the market. In this case, central bank absorbs funds from the market and try to maintain a stability in this rate, AWCMR, call money rate. I hope you remember it. Okay. And then, what is the other market? Now, Krishni told me primary dealer story. Primary dealers are also in the other market. Now, in the call money market, only the banks. The other mean of borrowing, banks also can borrow, primary dealers also can borrow. What is that market? The first one you already know, interbank market. The second option I'm asking. Primary market. Okay, what do you mean by primary market? I think you are referring to the treasury bill primary market. Is that the answer? Okay, they are actually, Krishni, that is when the central bank issues government securities, there is a primary market. Anyone can come and buy securities as investments, right? Now here I'm asking, to fulfill the commercial bank's funding needs, they are short of funds. How they can borrow? That is the answer. That is my, that is the question that I'm asking. So primary market, what you are telling is basically to invest. This is to borrow. But you are right, primary dealers also borrow in this market, and commercial banks also borrow in this market. Does anyone have any idea? Money market. Okay, Dilshan says money market. Now, your answer is right, but answer is broad, Dilshan. Now, money market is the term that you can use for both markets. The coal money market is also under money market. The other market we are talking is also under the money market. Money market means simply the short-term market. In our next discussion, actually, I'll be discussing this, the money market, capital market, and all that. So the answer is coming under money market. You are right, but I'm asking, what is the specific market? Commercial paper market. Now, Nadish, now commercial paper market, okay, that is also one way of, raising money. That's true. But it's not an overnight market. Okay. Overnight means you are not trying to fulfill short-term funds in the commercial paper market. Maybe you are trying to raise money for, let's say, 3 months or 1 year. It's not overnight. The particular market I'm talking is basically serving for the overnight needs. You need money today and you can settle tomorrow. That is the idea. So without taking much time, because I got another questions also, that is basically repurchase market, or you call it repo market. Repo market. Okay, repurchase market, or you call it repo market. So the rate in this market is average weighted repo rate. For the central bank publishes AWRR for this matter. So banks can come to this market also. What is the difference between two markets? Interbank whole money market, what is the significance? When banks borrow in the coal money market, the main advantage is you don't need any securities. So no securities, which means you don't keep any collaterals, right? But in the repurchase market, you have to have securities, which means T-bills and T-bonds. You need these instruments to borrow in the repo market. Both are under money market. As Dilshan said, you can call it the money market. I hope it's clear, right? So I gave you some extra explanation because for additional understanding. Okay, next question. List two risk associated with market trading activities of banks. I repeat, list two risks associated with market trading activities of banks. Market trading. So what do you call it? What is this risk actually? Risk associated in market trading. Sorry. What do you call it? Vimandi, liquidity risk means basically when you are trying to sell the security, right? So the possibility or the inability to sell it quickly, liquidity risk. That is also related to market, but there is a specific thing that we are talking about the market trading. What is that risk? Risk related to the market. What do you call it? Market trading. Shall we give another try, Vimandi? Do you have any other answer other than liquidity risk? Market risk, correct. So commercial banks are facing a risk when they are trading in the market. You call it market risk. Now the question is, list down two risks in this market. What are the risks that we have in this market? At least we know three. What are these three? Under market risk, we have what? Market risk means simply what? Risk arising due to changes in the prices. Remember? So what are the risks we have due to changes in prices? Yes, exchange rate risk, interest rate risk, correct occasion, and then change in interest rate means interest risk. We can include one more, exchange risk, interest risk. What is the other risk? Equity risk, yes, or you can call it, remember, asset price risk. Actually, equity comes under asset prices. So asset price is also one of the risks, as Vimandi also mentioned. So that is also one important area that we can look at. Then I move to another question. Briefly explain bank assurance. Bank assurance. This is actually a product, but here, we can discuss it because that is related to banks. What do you mean by bank assurance? Does anyone is having an answer? So since we have limited time, okay, Vimandi, selling insurance product through banks, correct. So what you are telling is correct. It is an insurance product sold by the insurance companies through banks, right? That is the difference. The product is not offered by banks. It is offered by insurance companies, but those are sold through the banks. So the bank role is basically as an intermediary. Bank is an intermediary, taking funds, giving away. So likewise here, the bank is providing intermediary service to sell the insurance product. So the customer details and all that, the banks would share with the finance companies. Sorry, the insurance companies. Right. Let me see another question. So in question 2, there is a question for 5 marks actually. 5 marks. So this question says, explain credit risk and liquidity risk. Now we already know what is credit risk. Basically, the non-repayment of the loan by the borrower, or basically default of the loan and the principal, including the principal and interest by the borrower. Or it could be non-repayment of the investments by the banks, by the borrower. Even borrowers can issue securities, no? So when you buy a security, if the if the borrower does not pay for that security, that is also a default. So both are coming under credit risk. Liquidity risk, I told you, basically arising due to the funding needs, the shortage of the funding needs. So basically, in the banking context, liquidity risk indicate the banks are unable to meet their customer demands. So which means you don't have enough liquidity. And you cannot, sell your products or your securities easily in the market. So liquidity risk can be explained in either way. in the context of banking, liquidity risk means an inability to pay for depositors when they ask money. From a broader perspective, liquidity risk means the inability to sell securities and make money at a short notice, right? Now, there's another part of the question. Discuss how the credit risk arising from lending activities would lead to liquidity risk. Now, these two risks are related because one risk could lead to another risk. For example, default risk is what? People are not paying. Liquidity risk means what? People are asking for money. So probably you will have a fund shortage when people are not paying. So you have a liquidity shortage when you don't receive your loans back. And when people are asking for their deposits, you don't have money to pay. So in that case, both are related. Any credit risk or default risk could lead to a liquidity risk. There is a linkage. Okay. So that is also one of the questions coming in your paper. There's another question related to regulatory ratios, like as I said, capital, liquidity. For those, you have different ratios. I'm not going to cover that here because we will come back to our last session on bank regulation. There you will observe or find an answer there. I remember I mentioned another question based on the technological developments in the banking sector. That is basically branchless banking. I hope you remember I told you to look at the question paper. Branchless banking. Is anyone having any idea about this? Branchless banking. Branchless banking. Any idea on this? Any response? Branchless banking means what? Is it too difficult to answer? Now, branchless banking is simply the banks are providing banking services beyond the traditional banking network. Or branchless banking is basically delivering banking services outside the conventional branches. Outside the conventional branches through technology. So conventional banking means usually we call it as a brick and mortar type banking. Brick and mortar type means is a physical, location is there. A branch is there. So in a branch banking system, you go to the branch and you go to the counter teller, you meet people physically, the banker, and you get the service. That is the idea. In branchless banking, you don't meet them physically in the most of the cases, but you use basically the technology to fulfill your banking delivery or banking services, right? So basically, your bank service is provided through some other modes rather than having a branch or a counter. So what are these other sources? One is point of sales, POS, right? For example, you have seen these machines, POS machines. So without meeting or the going to the bank, you can do a payment through a point of sales machine, POS machine. You can use payment cards. That is also a method of branchless banking. Internet banking, right? Mobile banking. That is also one way of uh, doing transactions uh, through branchless banking. And also you can have this, I hope you know this word, kiosk. In the bank itself, if you go to the bank or even outside the bank, there could be some service terminals, right? Service terminals, and you are doing basically, do banking activity on your own, maybe through the phone, maybe you log into the internet, maybe a small cubicle, so you call it a kiosk. Or maybe one officer is there, but he's providing services to many people, directing people to these kiosks. So that is also one of the, and also agents are also there. Without banks, you can use the facility of the agents. But traditional banking is different. As I said, you need to have a physical location, brick and mortar type, banking type. You need a large staff. You need to have other facilities. You need to have premises. But in branchless banking, you only need a minimum number of staff and technology, basically. So that has eliminated face-to-face interaction in the banking services. You don't meet people physically. It's very less. I think especially during this COVID-19 period, I think the branchless banking, basically appeared to be very important. Even without visiting a bank, you can fulfill your banking needs. So that is some new way of fulfilling banking services. But there are some people would say, okay, branchless banking is fine, but also we need to have traditional banking. Traditional banking means simply the conventional type, branch banking. You go to the branch and get your service. So the argument is basically, some people would say, some remote area people or some poor people, they don't have enough technology, enough access to modern communication methods. So in that case, you need to have branch banking. So in developing countries, I think the argument for branch banking is also there to fulfill the needs of the certain segments in the society, but at the same time they also promote branchless banking. But of course, in advanced countries, branchless banking is a very famous method of delivering products. So in some countries, when you go to the bank, as I said, there are few people as the staff, but large number of kiosks and some terminals. You do your own banking. So that is one of the key developments with the technology that has taken place in the recent decades. Okay. So these questions now, if you look at our chat, most of the questions I think were directly related to our discussion on banks, and that they are coming from the very latest paper in September 2019 paper. We had these questions. If you add up all these things, I think it's more than 20-25 marks for these questions. Okay. Any questions? Can we move back to the slides? Any response? Kids, are you there? Do you have any questions? Or can we move? I spent some more time on banks because it is important, and I am aware that you study the same under commercial banking also, but still it's really worth to know these things because these are in our exam papers. Can I move to the next slide? All clear. Thanks, Yashni. So let's move to the slideshow again. Now we have covered banking sector very clearly. Now we are going to talk about other financial intermediaries except for banks. So banks are one type. Other than banks, there are some other non-bank financial intermediaries. We will discuss them one by one. So one of the financial intermediaries we observe in many countries is non-bank financial institutions, NBFIs. You call them as NBFIs or non-bank financial institutions. Who are these institutions? Basically, what is their model? Non-bank institutions. Non-bank institutions are the banks, not the banks, financial institutions who are providing banking services without meeting a legal definition of a bank. Now, in other words, non-banks also provide banking services, but no legal definition of a bank, right? So when you don't have a legal definition of a bank, you can't do one thing actually, very clearly. You cannot transact with current accounts. Checkable deposits you can't accept, right? You don't have that product, checks, as NBFIs. But other than checks, NBFIs can do or can provide other services similar to a bank. For example, they can offer deposits like savings and time. They can make loans or any other credit facilities. They can have savings products, not only deposits. They can, define or develop some other savings products, investments, money transferring services. They can do whatever these activities which are also done by the banks. Now, in many countries, non-banking sector, they support in property market, which means in real estate market especially. They support in conducting studies or doing feasibility reports in about companies and possible investment avenues. So those are the things done by a non-bank financial institutions. And I know you also have some idea. In Sri Lanka also we have these non-bank financial institutions, NBFIs. We call them as finance companies in our case, right? Finance companies, licensed finance companies means basically non-bank institutions. So if you look at their model, they provide actually the banking services to their customers without having a license of a bank. So to become a bank, you have to have the license. So, but they don't have the license, so they are working as non-bank financial institutions. Actually, some of these non-bank financial institutions, they are bigger than the banks, and so they are doing well in better. They are doing better than the banks. So that is the situation in Sri Lanka. They are finance companies providing services to the customers, and most of the finance companies, they are into property business, especially buying and selling of lands, and also providing leasing facilities. I think you have some idea. Most of the finance companies, they provide leasing facilities. So the non-banking sector is a segment that is providing banking services without any legal definition of the bank. Why this segment is important, right? Why do you need to have this segment? What is the purpose? If you look at the financial sector, the banking sector is providing services to certain categories, certain customers. But in the economy, there could be some people, they cannot basically afford banks, so they cannot basically access the banks for their funding needs. The reason is they are basically substandard means they are not good as a bank. So in that sense, they are basically having some lower credit rating, lower asset base and things that like that compared to bank. So in that nature, they act as non-bank financial institutions, but overall they looks like a bank but no license of a bank. Okay? I hope it's clear. The example from Sri Lanka is finance companies. And then we have merchant banks and investment banks as financial intermediaries. Merchant banks are basic. Now, both investment bank and merchant banks, they are actually doing a very similar service. By name, they are helping basically investment and portfolio management, basically, right? Broadly, both companies, both type of intermediaries, they help in merchant for investment and fund management purposes through merchant banks and investment banks. Now, what is the difference then? Merchant banks are working with companies with who do not have you know large access to the public, or in other words, they are not large enough to raise funds from the public. Now, to go to the public and ask for funds, how do you ask funds? Basically, being a private entity, how do you ask funds from the public? Either you can issue an equity, either you can issue a debenture, corporate debenture. Those are the two avenues. But in some cases, to issue stocks or shares or debentures, you have to have sufficient size. It should be well established or large institution. So there are some companies, they want to raise money for expansion, but they do not have sufficient size, or maybe they are very small. So that is the role of the merchant. And also there are some companies, they do not have uh, proper regulatory or disclosure methodologies, like providing information to the investors at adequate level, and they are not having sophisticated systems like that. So all these indicate they are helping to a certain category, certain segment in the society. Like these finance companies, they are supporting a certain segment in the economy who are not having enough access to the formal banking sector. Similarly, here merchant banks are helping with companies that may not be large enough to raise funds from the public. Investment bank is different in that sense. They are trying to support the investors basically through issuing, trading and investing securities, mainly with the large firms. So large firms are basically supported by an investment bank. For example, they can help a company to issue shares, do an IPO, you call it an IPO, initial public offering, or they can basically do underwriting. Underwriting means simply the idea is the 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 investment bank is issuing shares to the public on behalf of that company, and let's say the full shares are not fully subscribed, not everyone is buying shares, so in that case they are not capable to enough to raise the total funds they need. So what is the option? Underwriting. Underwriting means the investment bank would say, so even if your entire shares are not sold, we will help you or we will buy, basically giving some assurance to the issuer. And also they help with companies having good financial records, very comprehensive disclosure requirements or methodologies, or when they have some sophisticated investors, some attractive investors, then the investment bank would provide some service, right? And they also can do some research on behalf of the clients. They can do some advisory services to their companies on mergers and acquisitions. Mergers means, or acquisition means basically to amalgamate two institutions, for that matter. They can give some advice. So if you look at the both types of here I have put you some additional information also about investment bank. So the basic idea is investment bank is a type of a very catering for a very formal sector. Having accounts means having disclosure procedures, means that is basically a very standard a formal segment. Whereas investment banks are providing services to some small scale entities who are not having proper financials or not large enough to attract investors. Okay, that is the difference. Leasing companies, I think you have some idea about the leasing product. Leasing is a contractual agreement between the two parties. Basically there are two parties called lessee and the lessor. Lessee means person who's liable to pay to the lessor. Liable to pay means he is basically taking the leasing facility. And the lessor means the owner of the asset. Now, whenever you get a lease, there are two parties involved, lessee and lessor. But in a leasing contract, the lessee does not have any authority over the asset. So the authority over the asset is with the owner, which means sometimes you call them as absolute owners. Absolute owners means they are the entire owner of the asset. Although the leasing the person who has taken leasing facility is utilizing the asset, or he is maintaining the asset, he does not get the ownership, right? Ownership is effectively conveyed to the lessee in the time of need and also at the maturity. Otherwise, basically the company owner will have the ownership of the asset. Lessee, he has to incur all benefits. Let's say it's a car, you get a facility for a car. So as the owner of the car, not actually the owner, as the user of the car, person who's having the leasing facility or having called as a lessee, he has to run all the costs or bear all the costs, risk, but also he can have the benefits in terms of the project. But in the case of lessor, he is basically uh, not incurring any cost or any uh, special benefits as the owner of the asset, right? So that is the difference between lessee and lessor in their role. Building societies and credit unions, these are types of different models of uh, thriftiness. Thriftiness means savings. So savings are done or can be done in various forms. So these building societies, BS, and credit unions, they are actually new to us, because in our case we don't have these institutions, building societies. Even credit unions we do not have, but these are basically coming from the UK context. In the UK, they have these institutions like thrift institutions or building societies. So building society is a financial institution owned by members as a mutual organization. So in this mutual organization, there are owners, basically the members of the society. Okay. And the building societies basically offer banking and related services, especially mortgage mortgage loans. I think that could be the reason for these banks to, to be named as a building society. Their prime objective is to give loans or lending facilities to the mortgage sector and housing. As I said, especially in the UK, they had this model, and their building societies basically supported the banking system, especially through mortgage lending activities. Okay. Credit union, again, it's a member-owned financial institution controlled by the owners. Very similar to building society. Here also you have members who are controlling the institution. They're trying to promote the thrift, which means basically the savings habits, provide credit at competitive rates, provide other financial services to their members. So that is also one of the functions of an investment bank. They also offer financial services similar to a bank, but under different terminology, like share accounts, share draft accounts, share term deposit certificates. All are very similar to traditional banking products, but they use different names: share account, share draft accounts, share checking accounts. Likewise, they have different connotation or different set of policies, products that they have to support to implement these building societies and credit union activities. Okay. Microfinance institutions. Now, microfinance is a relatively a new concept, new in the sense it was already there, but popularized, especially, I think, I hope you have heard this model in Bangladesh. So in Bangladesh, they started this model, microfinance model. I assume you may have heard a person called Muhammad Yunus, right? Muhammad Yunus, he is basically a Nobel Prize winner, for introducing this microfinance concept in the case of Bangladesh. So he basically introduced microfinance as a source of financial services for entrepreneurs and small businesses without having banking access and related services. So microfinance is provided for persons who are not having enough access to banks, who are not having proper access to the proper financial system. They are basically having kind of a uh, facility for small, medium scale, and even micro enterprises and entrepreneurs. So that is basically the model of microfinance. So how this microfinance is delivered? There is a relationship based banking where you give loans and facilities to individual entrepreneurships or small businesses. And the other model is group based model. So this is the most famous model in microfinance: group based lending and deposit. Now, for example, let's say if you want to borrow from a bank under microfinance methodology, you have to form a group, right? So as the group you borrow, especially for activities, economic activities, let's say uh, an agricultural activity in your area. So you can borrow as a microfinance client uh, as a group. So the group will borrow, group is repaying, group is responsible for any default. Now, for example, you have a five-member group, one is defaulting. So your task is to keep that person, intact, basically to service the loan. So in that sense, the microfinance is a kind of a collective method that you allow the people to enjoy financial services. And microfinance institutions, actually uh, they are not deposit taking institutions, right? You have to be very clear. Microfinance institutions, they do not take deposits. They basically have their funds to be dispersed. How do they get funds? There could be various ways. Now, one method is getting funds is, for example, they are shareholders. They have money and they can, give it as microfinance loans. That is one way. Other method, you can have foreign funding line for your institution and you give loans and you earn a profit. Other method is maybe from the government, you are getting funds. Central bank, or let's say the government is having funds and giving you the funds as the microfinance institutions to provide facilities to the people who are having low income people. So you are given some task to serve. So they cannot take deposits. That is the point I want to make. If it is a microfinance institution, it is providing loans at maybe concession rates, whatever, but basically supporting the medium, micro, and uh, small scale uh, enterprises, right? So under microfinance facilities, there are small loans, as I said, even insurance. There is a product called micro insurance product, similar to this microfinance, and there are things like advisory services that is also provided by the uh, microfinance institutions, right? This basically they are acting as middlemen. They get funds from somewhere, they distribute funds for a margin, right? So they earn a kind of a margin. Even in Sri Lanka, there are a number of hundreds of microfinance institutions who are getting funds externally or their own funds, but they do not raise any deposits. That is the difference. Maybe they are charging a membership fee as a member of the microfinance association, but no deposits can be taken. Insurance companies. Now, up to now, we didn't know actually insurance company is a financial intermediary, didn't you? You just thought they are providing a service. But they are also financial intermediaries. Why? They are collecting money from someone else and channeling that funds to someone else. In other words, they get money from policyholders. They invest money into other areas, giving loans or giving buying treasury bills or whatever. So in that sense, they are also financial intermediaries. So what is the model of insurance? There is an agreement or arrangement to protect from a situation or give some compensation for future losses of the value due to an unforeseen event. You don't know what will happen tomorrow or even in the next minute. You take a risk, and to minimize that risk, you take a certain buffer. So that buffer is a kind of a protection that you have in the case of a loss to you due to this unforeseen event. You get some compensation from the insurance company. So the insurer, or you call him as insurance carrier, basically he's selling insurance, and the insurer in the policyholder basically who's having the insurance, he buys the policy, and in the case of a requirement, he can basically surrender that policy, the insurance policy, and ask for any compensation, right? Any compensation. So this amount of money taken in terms of activating an insurance, or be an active member continuously in the insurance plan, you have to make a payment. You have to do a certain payment. That payment, usually you call it as the premium. So insurance companies are charging a premium like any other bank or any financial institution. They charge a premium for their service, right? So in that sense, insurance companies, they collect premiums, invest those premiums, the surplus, and generate some investment returns. And most importantly, insurance companies are paying in the case of a loss. So if there is a loss to a policyholder, let's say there are different types of insurance. No, you have an insurance for the car. So let's say your car got damaged. So the insurance holder will pay you. Sorry, the insurance company will pay you as the holder as a compensation. There are different categories. Long-term insurance, normally you call them as life insurance. There is general insurance, simply based in our case, we call it as vehicle insurance, right? Vehicle insurance. But in some countries, this general insurance, even in Sri Lanka, I think we have, you can insure any product, any like your machines, your house, your furniture, anything can be insured. Long-term life means basically a human being would be insured in the case of his illness or a death or whatever. You can ask for a compensation is the real idea behind insurance. Even reinsurance is there. Reinsurance means you are an insurance carrier or a provider. You are also insured with another party. In the case of a let's say a large demand for insurance, you have to have some backup. Now, for example, the best example is in 2004 when the tsunami happened. uh, you know there was a large demand for insurance claims. Luckily, that tsunami was not covered by, I think, the insurance companies in the insurance agreement, so that they escaped, most of them. But people who had to pay, it's a hit to the company. Why? Large number of people would be claiming for insurance. So in that case, reinsurance would be helpful, which means you are insuring back with another company. This is happening when you do trading, export import trade. So you have reinsurance, which means some other company is giving an insurance to your insurance company. So if you look at the business parties, insurance brokers are there, agents are there, loss adjusters and all that, these are there. The subject is handled by actuarians. I think you know you have some idea about actuarians, who people value or do some modeling or estimates to see uh, the 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 future of the insurance plan and all that. Okay, some analytical people. I hope you have some idea about these products that we, not the products, the providers that we discuss up to now. Now we got couple of other intermediaries as well. One is factoring companies. Factoring company means they are not helping for factory. Factoring means it's an idea, kind of a third party financing. So these companies are providing third party financing uh, for the purpose of, companies to carry on their business, for the exchange of their unpaid invoices. If I say it in very simple terms, with a factoring company, you can, let's say you are a good seller, you are a garment provider to a famous shop. So when you provide garments or clothes to the shop, probably you might not get money outright. So you will get your money later. So in that case, you have invoices, right? So factoring means you can sell these invoices. You call them as account receivables, these invoices. So these account receivables can be given to a third party. That third party is called as a factor. Factor. How do you give it to a third party? At a discount, right? Sorry. So you give it to a discount. Discount means, let's say you have 100 million of bills, you give it to the factoring company for 95 million. So the factoring company can make some money out of that. So they are basically collectors of account receivables. Why? What is the importance of this company? Because they are helping to cover the business expenses, immediate cash needs, until their customers are paid. Until their customers, I think there's a word missing here. Here you have to write down, until their customers pay, right? Uh, so when the customers pay only, the company will receive money. So up to that point, you have to run. So how do you run? Factoring company can give you money. That is one of the models. And some cases you have to pay a fee for the company. Even though you are selling your bills at discount, you may have to pay a fee to the company. I think in Sri Lanka, it's not a very famous model. I remember one of the companies, one bank actually, they provided this factoring services. I think it is called as Sampath Factoring. So they were providing this sometimes back. Cooperative banks. Now these banks are simply, I think this is a very familiar model in Sri Lanka, that is helping to mobilize savings from the mainly from the rural areas and the agricultural areas. So they are mobilizing savings in the uh, remote areas or in the village levels mainly. on the urban city, you don't find, cooperative model. It's very rare. It's there, but it's rare. Mainly, they help mobilizing funds in the agriculture sector, and as I said, in the to serve the poor segments by stimulating their activities. So cooperative is a member-owned institution, right? So the owners are the members, or members are the owners. So they form a company towards financing their needs, towards financing their needs. So these are not regulated directly by a financial authority or a central bank, but there could be some linkages to the central bank or the authority, or there could be other cooperative legislations, like applicable for companies, applicable for departments. Likewise, for example, in Sri Lanka, cooperative banks are monitored or regulated by a ministry, I think, a department, cooperative services department, under a certain ministry. It's not under the central bank. So this is a different model. So in Sri Lanka, probably you may have seen in village areas or in remote areas, these cooperative banks are very active. They are providing services to their member based. That's one of the important models, especially in the developing countries. And then another financial intermediary is a pension fund companies. Pension fund is a kind of a superannuation fund. You call it superannuation fund, which is providing a facility at your retirement. So a corporate, the pension fund or the superannuation fund provides some retirement income. Retirement income. So how this model happens or works? So the pension fund or the superannuation company collects your contributions in advance. So while you are working, you give your contribution to the fund when you are an active employee. So you contribute to the fund. Maybe your employer is also contributing to the fund. And through these collection of funds, it becomes a large fund actually. Most of the pension funds they are very huge, very large funds. So these large funds are invested in many markets, mainly in the government securities markets, in the stock markets. And if you look at advanced countries, the pension funds are the largest investors in the stock market, right? In Sri Lanka, pension funds are largest investors in the bond market actually, because our stock market is small. But if you look at other countries, foreign countries like Europe or in Australia, they are listed companies, or the stock markets are basically invested by or provided funds by the pension funds. So there are defined contributions and defined benefits, which means at the beginning you have very clear way of defining the contribution amount and all that. The benefit would also be defined very clearly. What is the percentage you get, whether you are getting it as a retirement plan, or a monthly income, or a lump sum amount, or in combination. In some countries you get the lump sum, the total at the retirement. In some countries you get it as a pension until you die. In some countries it's a combination, right? And there are funded, fully funded and underfunded pension funds. Fully funded means the fund is entirely funded by the contributors, or basically the members. Underfunded means the members partly contribute, the some part is basically provided by the other, you know, investor or a government. For example, the government can give the money to set up the fund. So in that case, it's an underfunded one. So it's a, if it is a fully funded, the members are fully contributing. Unit trust, why they are financial intermediaries? Again, they are also playing a similar role. They collect funds from a certain segment and channeling funds to another segment. So unit trusts are called as mutual funds. In some books, you may have seen this term, unit trust companies or mutual funds companies. So their role is basically to collect savings from retail type small scale investors and invest such money in financial markets. So unit trusts are issuing units to the investors. So by issuing units to investors, they raise funds. That's why you call it unit trust. And the people who are buying units, they can buy, sell these units. You can, like shares, you can buy shares or sell shares. No, likewise, you can buy units or sell units. So these are kind of small pieces of investment of the fund. So the fund collected through these units are invested in various assets. So some funds are like invested in stock markets. Some funds are invested in bond markets. Some funds are invested in banks. Some funds are invested in, you know, other avenues. Some, they have a collection of the investment avenues. 50% of equity, 20% of deposits, 30% of bonds. Likewise, there could be a combination also, right? So the role of the unit trust or the mutual funds company is to ensure that the collected money is pooled, and that pool is invested in various assets. And if you are a unit holder, you can sell back those units to the, you know, the trust or in the markets, as I said, but at current market prices. So it's like the stock market. And unit holders are getting dividends annually from the profit, because the company makes profit out of the investment. And based on that profit, the unit holders will get dividends proportionately annually, right? So that's a very similar model to the stock market. But this is important because everyone may not be in the stock market because of various reasons. Some people, they are not in the stock market. Some small retail investors, they are, you know, very, you know, backward. They don't, they would not like to come to the stock market and do their activities. So in that case, the stock market can be accessed by the small investors through unit trust. And the last financial intermediary that I'm going to discuss is escrow companies. Escrow. This is a new or some relatively new term. Escrow companies. Escrow company would hold money or documents between parties. Let's say you have party A, party B. You do transactions, so you exchange documents. To assure the safetiness and the transaction is, you know, happening, you can have a third party, neutral third party, to buy or sell assets or to transfer documents. So this third party is called as a escrow or escrow company. So it's a legal concept where you facilitate as an intermediary. Now, related to escrow companies, there is a term called escrow accounts. Escrow accounts. So in these escrow accounts, the money is held between two parties, A and B, we have transactions, no? So the transacting money is held by the escrow account or the escrow company. So escrow company is ensuring when the transaction happens, party A channel funds to the escrow company, and escrow company ensures that funds will be channeled to company B, right? For the party B. And that way you ensure that the transaction is happening without any problem. Now, one of the best examples to understand this escrow concept is the real estate transactions. Real estate transaction. Now we know this apartment business. No? Now we around this area also you will see a lot of apartment being built. Now what is the problem with the apartment building? Now apartment building companies, they find a land plot and they market it, and the buyers would come and they are selling apartments basically which you don't see, right? You just see only a board or a plan or a nice model. You don't see the apartment on the ground in reality. So it's a concept only. You are paying money for the concept, right? So by collecting that money, the company will start building the apartment, right? So they will ask, give us 10%, 20%, 30%. Likewise, stage by stage, they will be building most of the apartments. Now, what is the assurance that you will have the apartment at the end of the period? What is the assurance that they will build it? Why? The reason is most of the apartment builders, you call them as property developers, they use this money to finance other projects, right? You are getting money for, let's say, project A and using that money for project B, project C, some other projects. At the end, project A is not done. You have all paid, but you don't have an apartment. You only have a small land plot surrounded by these metal fence. It's only at early stage. It's not completed. So that is a risk. To reduce the risk, you use these escrow companies. So this is actually mainly originated to popularize mainly in the case of India, the escrow concept, because India has a boom of apartments. So the companies, they collected funds from the buyers of the apartments, and that company is keeping money in that account. And whenever the apartment company, the property builder is basically showing some progress, the escrow company would release money. So that can be done not only for money, even for documents. For delivery of documents can be done through an escrow company. So that is a very important. Now I'm introducing or teaching this escrow concept for the first time actually. Up to now, I haven't taught this in the class, but it is a very important idea that is coming out, escrow. Okay. So we have some broad idea about different types of financial providers, financial intermediaries. And we also know there is another type of financial institutions, which we call them as service providers. Service providers. So let's quickly run through some of the service providers. I think most of the things are self-explanatory. I will just run very quickly. Now, there are financial advisors. They are helping you to, basically as professionals, they will help you to do some financial planning, to do some investment, to buy insurance, or they will give you some advice on the investments, retirement plans. So in Sri Lanka, this financial advisory area is not that popular, but in Western countries, it's a very promising area, financial advisory companies. or financial planners. In some countries, you call them as financial planners. They will plan and offer you products according to your needs. Second, there are fund management or asset management companies. Let's say you have money, you don't know how to manage it. So you can get the help of the asset management company, which means you are not giving money to him, not transferring, right? You have money in your portfolio, but they help you to manage. They will tell you, okay, we'll invest this much of money this in this asset, this much in this asset. Likewise, they will give you some opportunities or some more options to diversify your money and to earn a kind of a profit through prudent investments. So like you are getting some external knowledge, expertise for your investment. Brokers are there, right? Brokers are basically, I think we are very familiar with the concept of broker. No? We know there are many brokers, house brokers, even marriage brokers, right? So the same concept. So the broker is an individual or a party arranging the transaction between the buyer and seller. He arranges the transaction, right? So he is arranging one person, arranging the other person, and he is basically facilitating the transaction. And when the transaction is executed, you get your fee. It's very similar to the marriage, as I said. You arrange two people and the marriage is done, you get your fee. Likewise, in the financial market, you can do brokerage. Stockbrokers, the best example. So stockbrokers are buying, finding people to buy stocks, finding people to sell stocks. They are meeting those two people, and when the transaction is executed, you get some income out of that. Real estate brokers, the same concept. And these brokers are furnishing very important information about prices, products, and market conditions. And there are venture capital companies. So venture capital, the idea is simply providing money to start up businesses. Venture capital means seed capital or seed money for startup companies, right? Startup companies. Basically, you support some activities done by startup companies. For example, let's say in the technological field, you have some companies who are having, great potential, but they don't have money. So venture capital comes and gives some money for them to start the business, to run the business well. And by that way, they will grow. And when the company is growing and matures, the venture capital company can exit, or he can find another new venture. So this concept is basically coming from the concept of angel investors. Angel investors popularized in the Western countries. So angel investors means they are high net worth individuals. They are having money. They are finding out people to, support, not for free. They also want to earn a profit, and also they want to do some innovations. So now, for example, with the Moratuwa University in Sri Lanka, they have this venture capital, projects, angel investments, because they do some innovation. Some banks in Sri Lanka, they do venture capital for projects like power generation, healthcare projects. They do these type of projects, right? I hope it's clear. I'm just thinking whether I missed one. Okay, it's here, right? So venture capital, I think you have some idea as per the explanation that I have given. So let's try a couple of minutes and let's see whether we can finish this handout quickly. Yes, I think I hope we can do it. Would you mind if I take 5 minutes more? It's almost 5:40. Is it okay if I take 5 minutes? I still see all, I think most of the people are here. So let's try to finish it. Then we can start a new session next week, right? And also there are some payment service providers. Basically, they provide online services for electronic payments. So the best example for payment service providers is card providers, card companies. I think in the next slide we have these card companies. So there are some companies who are basically offering the platform for electronic payments, for like cards, bank-based payments, direct debits, which means you transfer money directly, bank transfers, online banking. All these are basically provided by payment service providers. So they are basically some software based services. So they do provide some gateway for the clients or the merchants to do multiple payments, payment service providers. Similarly, as I said, card companies, they are issuing cards for the holders, giving an option to borrow funds or to borrow funds for the purpose of buying goods and services. You know the working of a credit card. We will discuss credit card in a later discussion. So they are using basically a kind of a credit product. You use it to borrow, right? So the credit card companies like these Visa, MasterCard, Amex company, these are, card companies offering the product. So the cards are owned by them. Even the banks are issuing it. The platform of the card usage is basically owned by these companies. So the card is basically provided by them. So that is another payment service provided by the financial institutions. Money changers and dealers are there. Money changers are basically, I think you are very familiar with this idea, people who are exchanging currency from one currency to another currency. Now in Colombo, in Fort area, we have money changers, authorized money changers. They are basically exchanging currency. In Sri Lanka, actually, they only can buy foreign currency. But in some countries, if you go to an airport, you will see money exchanges are there. So they exchange currency to another currency. That is not intermediation, basically providing a payment, some financial service. Dealers. I wanted to make a difference between that broker and dealer. So here you find it. Now, broker is basically facilitating transaction and get a commission out of that. Dealer is not like that. Dealer is basically buying securities to his own account at the bid price. You call it bid price. Buying securities for his portfolio at the bid price and selling those securities at a later point from his portfolio at the ask price. So what is his income? The profit, the difference between bid price, the buying price, and the ask price, which means the selling price, is the profit. Difference between bid and the ask is the profit for the dealer. Now compared to the broker, what is the difference? Broker does not have a portfolio, but dealer, he is having a portfolio and he is also buying and selling for his portfolio. Best example is primary dealers in Sri Lanka. So primary dealers are buying and selling government securities and making profit with the difference of bid and ask price. Okay. Very quickly, there are exchanges, they are like marketplaces facilitating financial transactions. The best example is the stock exchange. In the stock exchange, it's a platform, it's a marketplace providing some support to securities to be exchanged, commodities to be exchanged. Now there are commodity exchanges, gold exchanges, silver exchanges, copper exchanges. So basically it's infrastructure, right? Providing some infrastructure to trade financial instruments. So it's a kind of an organized and regulated market. That is the important thing, right? An exchange is an organized or regulated market. Now, for example, in the stock exchange, it is organized. It is regulated by the Securities and Exchange Commission, where you trade stocks. So that is also one way of providing financial services. Depositories. Now, this is an exam question. In most of the exam questions, we have seen these securities deposition. So depository. So where this is an organization, or you can call it an institution, where you keep certificates in a store. So you store your securities until they get transferred, or until another people acquires those securities. Now, for example, in Colombo, in Sri Lanka, we have central depository system, which means all stock details are held in one location. CDS, you call it CDS. There are two CDSs in Sri Lanka, one at the central bank for government securities, one at the stock exchange for equities, stocks. So there you store the details of the transactions. Right? Now you don't have the security certificate with you. It's with the depository. So in that way, it is a storage as well as it facilitates smooth clearing, which means when you sell the security, the transferring of the ownership is done in the depository, right? You don't have to do it manually. So that is happening electronically in the depository. So that is also one of the important services. Last slide, and the last type of financial service providing is crowdfunding. This is also I added very recently. This is also new development that has taken in the global financial market recently. Here you are not intermediary or doing any intermediation. You are basically providing a platform to fund a project or a venture, by a venture by raising small amounts of money from large amount of people, mainly through internet. Crowdfunding. Crowdfunding is simply you create an internet platform and you invite other people to come and invest or come and donate for a project. So there is a risk, but some people take that risk and invest. So when the project becomes profitable, you get some return or you get some other benefits. Now this crowdfunding is very popular in some areas, like let's say art industry. You are making a film, let's say. If you don't have money, you can create a crowdfunding platform and you can ask others to invest in your film. So if the film is successful, you can return money with a profit. And for medical expenses, for charity work also, you can do crowdfunding. You can create a platform and ask other people to basically contribute. It's like a community-based, a social entrepreneurship or a charity-based thing. Now, for this matter, there are companies, crowdfunding companies, to provide this service, because everyone cannot do it. Now, if you want to do a film, you can't simply create a crowdfunding platform, right? You have to have some support from a crowdfunding company. They will also charge some fee for that service. Now, in this discussion, if you look at, I mentioned some different types of financial service providers. Now, if you look at them, they are very different from intermediaries. They are not coming into the in between and help any transaction, but they are being in a side, they are helping to facilitate financial transactions. Advisory, asset management, brokerage, venture capital, payment service providing, dealers, exchanges, depositories, crowdfunding, all these are different ways and means of supporting transactions, right? I hope with that it's very clear. At the end, we have completed this discussion on financial institutions. I told you we are basically looking at three types of financial institutions. Central banks we have already covered in detail. Financial intermediaries, we spent something like 2 weeks to cover this part because intermediaries are the most important financial institutions. And today, in a very brief session, we covered financial service providers as well. There are past paper questions related to these areas, so please look at them. Time to time, we will try to get some questions and do some discussion. Next week, we are moving into a new topic, financial markets and securities, basically products. So before you come to the session, look at the slides very carefully, and I really recommend you come up with a at least some extra paper, because there are some writing, and also you have to have a calculator, right? We will do some calculations also, because in your paper you have some calculations related to these financial products. Okay, and with that, let's conclude for the day. And I'm very sorry I took extra 20 minutes, but it is within our 2 hours time frame. Thank you very much, and I'll see you next week, hopefully by 3:30, and have a good week. Let's finish at this moment. Thank you. Good night.